9 of the 10 largest hedge funds on Wall Street outsourced their plumbing to the same company. You have probably never heard its name. It runs the calculations that decide what your pension is worth, files the paperwork that keeps regulators happy, and quietly collects a fee on roughly $2.5 trillion in alternative assets. This is the story of how a Connecticut software firm became the most boring monopoly in finance, and why its biggest bet, a $5.4 billion acquisition in 2018, locked the moat shut forever. Start with this. Of the 10 biggest hedge fund managers on the planet, 9 of them are SS&C clients, not customers in some loose sense. Clients. Their funds run on SS&C's software, or SS&C employees calculate their daily net asset value, or both. SS&C GlobeOp administers roughly $2.5 trillion in alternative assets, and the Convergence 2024 league tables rank it the #1 fund administrator on the planet. Here is the unglamorous truth about a hedge fund. The partners pick the trades. Everyone else in the building either supports that or works in the back office. The back office is where you calculate today's net asset value, reconcile every trade with the prime broker, send capital statements to limited partners, and file the regulatory forms with the SEC and offshore regulators. Funds hate doing it. The work is mandatory, expensive, and offers zero competitive edge. So they hand it to SS&C and never look back. In 2024, that boring back office work generated $5.88 billion in GAAP revenue. Not a flashy number for fintech. But here is the catch. Almost none of that revenue is genuinely at risk in any given year. It is mostly contractually committed before the year even starts. Recurring fees on someone else's mandatory paperwork is one of the best business models ever invented. The customer cannot stop paying because the regulator will not let them stop. The vendor sets the price. The customer accepts it because rebuilding the plumbing is always more expensive than the bill. Look at the revenue line from 2017 to 2024, $1.7 billion, then $3.4, then $4.6. That cliff in 2018 is the tell. Something very specific happened in April of that year, and it permanently changed what kind of company SS&C was. On April 16, 2018, SS&C closed an all-cash acquisition of DST Systems for $5.4 billion. It was a bet the company deal. SS&C took on enormous debt to buy a company that did mutual fund record-keeping, the kind of business Wall Street analysts call mature, which is polite for boring. The thesis was simple and audacious. DST kept the books for huge swaths of the American mutual fund industry. SS&C kept the books for huge swaths of the hedge fund and private equity industry. Combined, you would administer roughly 13,000 client relationships and run at about $3.9 billion of annualized revenue on day one. Founder Bill Stone promised $175 million of annual cost synergies by year 3. The market was skeptical, the leverage was uncomfortable. The integration was painful, and then it worked. Skip ahead 6 years. Total revenue, $5.88 billion. GAAP net income attributable to SS&C, $760.5 million. Adjusted operating income, $2.21 billion. Adjusted operating margin, 37.6%. And the business converted all of that into $1.39 billion of operating cash flow in a single year. The bet did not just work, it compounded. Year on year, the machine just keeps grinding. Revenue up, adjusted operating income up, cash flow up, no drama, no pivot, no reinvention. Just incremental expansion of an annuity that other people are legally required to pay. This is the quiet monopoly thesis in one company. The best businesses on earth are not the loud ones. They are the toll booths sitting between something mandatory and someone who has to pay for it. SS&C does not pick stocks. It does not take market risk. It just charges a fee every time a hedge fund needs a number calculated, a report filed, or a record kept. And that fee is contractually locked in. The cable news version of finance is the noisy one. The version that actually compounds is this one. 82.3% of SS&C's 2024 revenue is software-enabled services. Translation, recurring outsourcing fees. $4.84 billion of work that automatically renews unless a fund decides to undertake a multi-year operations project to rip SS&C out of its plumbing. Almost no fund actually rips them out. The 5-year average retention rate on these contracts sits above 95%. That is not customer love. That is structural lock-in. And here's where the moat goes from strong to nearly impenetrable. When a hedge fund or private equity fund is launched, its limited partnership agreement names the administrator by contract. SS&C is written into the founding document of the fund. Switching means amending that LPA, notifying every limited partner, and in many cases triggering an investor redemption window. That is not a vendor relationship. That is a legal hostage situation. And the hostage pays the ransom every quarter for the life of the fund. So here is the lesson. Look past the operating businesses everyone argues about on cable television. The real compounders are the unglamorous toll booths sitting downstream of mandatory paperwork. SS&C bought its way into that position with 3 deals: GlobeOp for $834 million in 2012, Advent Software for $2.63 billion in 2015, and DST for $5.4 billion in 2018. Revenue went from $1.7 billion to nearly $6 billion in 7 years, and the business retains over 95% of those customers because they are contractually unable to leave. If you want to find the next quiet monopoly, stop looking at the product. Start looking at the contracts. Subscribe. We will keep finding them.